Good morning, and welcome to the 11th Annual FinTech Innovation Lab Demo Day. My name is David Riley, and I'm the CIO of Global Banking and Markets here at Bank of America. For the second year in a row, we're gathering virtually, and while we all can't be together in person, it doesn't diminish the importance of this event, and in fact, it makes it even more important. It's hard enough to get time with top banking leaders in normal times, but in a virtual world, it's near impossible. And this lab is giving these young companies access to the most important decision makers for their products. And for reasons like that, I'm proud to say that this is the 11th year of Bank of America sponsoring the program. And once again, the lab has brought together some terrific companies. We continue to support companies like Rightfoot and the Climate Service, which you'll hear from today, because the lab has become an important resource for the city and a key vehicle for us to engage with emerging innovation in financial services. And so let me thank the Partnership Fund for New York City, Accenture, and the New York City venture community, without whom this program simply would not be possible. The Partnership for New York City works across government, business, labour, and non-profits to enhance New York City's economy and maintain New York City as a global centre for commerce, for culture, and for innovation. And that's why, over the 12 weeks of the FinTech Innovation Lab, my peers and I spent hours giving these featured companies specific advice on a range of issues, including, are they solving a high enough priority problem for all of us? And is their value proposition compelling enough that a key decision maker will ultimately sign that all-important purchase order? We also provide guidance on how to navigate our procurement processes and meet our security and data handling requirements. And the partnership doesn't end when the 12 weeks are over. Besides deploying lab graduates to production, we continue discussions with prior lab alumni, sometimes years later, as they mature due to the advice they receive and create products and services that over time meet our strategic needs. Overall, the companies from the lab have raised more than $1.4 billion and created more than 1,300 jobs. A purpose of the lab is to increase job growth, and now more than ever, long-standing proven programs like this are critical to New York City's recovery. And that's one of the most unique aspects of the lab. Executives from more than 40 leading financial institutions who often compete come together to support and encourage the collaboration between their organizations and emerging tech startups. And in doing so, they're also supporting New York City's economy and continuing to ensure New York City is the center of FinTech. And it's also events like this one today that help ensure Bank of America stays on the leading edge of financial services innovation and showcase the criticality of establishing partnership between companies like the ones you'll hear from today and companies like ours. So thank you for your participation, for your commitment, and for your hard work. Enjoy the program, and thank you.
Hi, my name's Dave Treat, and I lead Accenture's Technology Incubation Group globally. It is my pleasure to co-chair the FinTech Innovation Lab here in New York alongside Maria Gotch at the Partnership for New York City. Let me start with some thank yous. First, let me begin by thanking Bank of America for hosting us virtually this morning. And thank you to all 44 financial institutions and insurance companies who are at the heart of the program, enabling meaningful access for the New York's tech startup community. This year, we especially welcome two new partnering institutions, Prudential Financial and Sumitomo Mitsui Banking Corporation. I also want to thank our partner venture capital firms, some of whom you will hear from during the Fireside chat later in the program. Lastly, many thanks to our entrepreneurs in residence and all the mentors who contribute on panels and office hours throughout the program. David Riley just shared the staggering results the program has had so far. Building on that, this year we logged more than 500 hours of direct access to financial service executives, mentors, and investors for the selected 10 startups in the 2021 cohort. I want to congratulate the 10 startups for being on the other side of this competitive selection process and for going through this intense acceleration journey of the past 12 weeks. These 10 companies are promoting some of the most promising advancements in financial technology today. They're helping provide innovative tools to address some of the most pressing topics, from quantifying the impact of climate change on an enterprise to improving student debt repayment rails, from simplifying data analysis using conversational AI to decoupling data from applications to reduce integration cost, among other topics. These companies are a testament to the key role the entrepreneur community is playing in the recovery from the pandemic and the rebuilding of our economy and New York. On this note, you will get to hear from the 10 startups from this year's cohort, each of whom will be introduced by one of their financial institution mentors. We're sure that after getting a snapshot of these companies during the event, you will come back to see the company's longer pitch and meet them in the breakout rooms. With that, I pass it to Diane Plevesky from JPMorgan Chase to introduce Rightfoot.
Hello, I'm Diane Plevesky with JPMorgan Chase. I'd like to introduce Rightfoot, which is helping financial services companies like ourselves enable our customers to better manage one of their most critical ongoing payments, which is student loans. Just given the enormous amount of student debt that many people carry, and I know I personally carried, I find Rightfoot's capabilities around better, more proactive financial management, using things like rewards points to pay down student debt, using smart tools to avoid overdrawing your account with your payments, and using the breadth of their direct integrations to help make sure our customers are paying off their highest interest loans first. Extremely interesting and very relevant. I think they're doing important work in this space, and Danny and the team have been phenomenal to work with, and I look forward to our continued explorations together.
Hi, everybody. My name is Danny. I'm the CEO and co-founder at Rightfoot, and we enable financial institutions to quickly and easily add debt repayment as a feature of any application, starting with student debt. Debt is not a routable account like a bank account, so it's actually difficult for third parties to pay. But we make it easy by directly integrating with loan servicers one by one, whose backends were built in the 1970s. Student debt is a massive financial and social problem. There's a $1.7 trillion student debt crisis that's growing at $33 billion a quarter, and 70% of college grads enter the workforce with student loans. But additionally, it's a social problem. 2/3 of all student debt is held by women, and minorities hold 30% more on average. When you think about what is the largest monthly recurring payment in a young person's life, it's student loans. The average amount is $395. And the average repayment period is about 20 years. So your 20-year-old customers have student loans, but so do your 40-year-olds. And chances are you're not offering a tailored solution today to help them manage and better pay off their student loans. This has massive spillover effects on your company because 61% of student loan borrowers are struggling to take out a mortgage, and more than 70% are struggling to save for retirement. That's where we help. Our APIs are flexible to fit any use case. So examples of how we work with financial institutions today is enabling them to, let's say, send roundups from within their digital experience directly to their highest interest loans, or send rewards points directly to their loans. Additionally, we work with companies in the benefit space like 401ks or benefits firms to launch a tax-free student debt repayment benefit for employers. We're backed by Bain Capital Ventures. My co-founders, Will and Deirdre, are also really excited to be here and working with you, and we'd love to continue the discussion. Thanks so much to the FinTech Innovation Lab for giving us this awesome opportunity. Previously, we were working primarily with personal financial management applications and benefits firms, and we're excited to work directly with large financial institutions today.
Hi, I'm Richard Tarling from Goldman Sachs, and it's my pleasure to introduce to you the Cinchy platform and the terrific team behind it. Throughout our industry, we're challenged by the ever-growing data sets we manage and the cost of integrating access to that data. Cinchy is a dataware platform that elevates data as a first-class concept in parallel to hardware and software to meet that challenge. It unifies data and frees applications from the complexities of storing, connecting, and protecting that data. Initially, the platform will serve to physically manifest virtualization of data ingested from external systems. Over time, however, as applications are reconceived around Cinchy, data will become native to the platform, decoupling applications from data and realizing the vision of dataware. The platform puts data, its design, and governance at the heart of application development and will fundamentally shift the way in which enterprise applications are developed. I now hand you over to Dan Demers, CEO of Cinchy.
Hi, I'm Dan, CEO at Cinchy. Cinchy is the first operational platform designed to treat data as a first-class citizen. Prior to founding Cinchy, my co-founder and I spent over 30 combined years at some of the largest banks in the world building complex systems. That's where we realized that over half of the IT budget of every company on the planet is wasted on integration, and every new application makes the problem worse. We created the Cinchy platform specifically to address this challenge. We've been in market now for just over 2 years and have over 100 organizations that are actively benefiting from our platform. This includes banks with over $1 trillion in assets under management. Several banks have deployed our platform across multiple business lines and dozens of use cases, and we don't have any churn. We're thrilled to be part of this year's FinTech Innovation Lab. I can't tell you exactly who we're working with, but if you add them up, it's over 14 trillion in combined assets under management, so we're pretty excited. Our platform is designed to augment our customers' existing investments and existing systems, enabling federated development on a shared data platform. With Cinchy, applications that you build can share data without any effort, without creating copies, and in a manner that is far more secure than traditional APIs and ETLs. We have a growing catalog of proven use cases. One of our more popular ones is what we call CRM augmentation, where you're using the platform to connect data from across fragmented CRMs into a unified data fabric and using that fabric as your foundation for building new digital experiences for customers, for employees, including onboarding and KYC, and even identifying cross-sell and upsell opportunities. This isn't a 360 view, this is a 360 experience. You have to see the platform in order to believe it. So please do drop by in our breakout room, and I'd love to show it to you live. I'm Dan, and we are Cinchy.
Hi, my name is Jack Birbiglia. I work at RBC Capital Markets in their technology group. Our capital markets partners are finding that access to our data and superior client service are more important now than ever. And with so much data available and more demands on accessing that data, we need ways to improve how we get to this data and make it easier rather than more challenging. Querio believes they have solutions for some of these problems with their conversational language interface to your company's data and other systems such as Salesforce. I'd like to introduce the CEO of Querio, KG Charles Harris.
Hi, I'm KG, founding CEO of Querio. We were incubated by Salesforce, and Salesforce is now bundling Querio to sell data services. We have created a software platform that translates human language to machine logic, enabling a plethora of use cases. With Querio, any business user can ask any question using their plain daily English and receive immediate answers. This means that business users in the front, mid, and back offices in financial institutions and insurance can instantly access the information they need to do their jobs. Users need no knowledge of data structures and can speak in total freeform without having to structure the sentences in any particular way. What makes us unique is that we solve for use cases where an infinite number of possible questions need accurate and verifiable answers. This is crucial when business decisions are made or actions taken. Our AI platform is based on symbolic systems approaches to artificial intelligence, which solves for these kinds of use cases where common approaches based upon machine learning and deep neural networks fail. Building Querio required a unique group of scientists, including Earl Sacerdote, who is an AI and language pioneer at Stanford, and Jim Cates, who was the global head of R&D at IBM and created the underlying technologies for Watson. The immediate market with Salesforce is $2 billion per year, and with use cases that span enterprise to consumer to smart cities, this expands to a multi-trillion-dollar market. We therefore have a partner-first strategy and have active engagement with major consultancies and ISVs like Salesforce, Accenture, and others. We're raising the balance of a $3.5 million convertible to execute on these partnerships and on our direct pipeline, including several opportunities from the FinTech Innovation Lab. Thank you.
Hi, I'm Shannon Sarley, and today I would like to introduce you to Spin Analytics. Banks are facing more regulatory oversight than ever before. And that oversight means that today it can take months to develop, test, document, and deliver production models for use cases such as CCAR and CECL. And let's not forget, that documentation needs to be updated every time the model gets updated as well, which leads to a lot of work. That's where Spin Analytics comes in. Their advanced risk robot platform utilizes AI machine learning to speed up that model development time by up to 90% and reduce the cost of model development by up to 70%. Not only does the platform do that, but it delivers model documentation in minutes. And that documentation will update every time you enhance and enrich your model as well. So to learn more about Spin Analytics, please welcome Panos, the CEO and founder, for his introduction to an amazing platform. Thank you.
Hello, ladies and gentlemen. My name is Panos and I'm the CEO of Spin Analytics. Spin Analytics brings digital transformation in the global banking industry. We developed Risk Robot. Risk Robot completely automates the manual process of developing and validating regulatory credit risk models. Risk Robot can reduce the time more than 90% and the cost more than 70%, and works globally by applying regulations like Basel III. Today, under the COVID-19 era, the credit risk modeling teams in all banks will need something more than machine learning, as regulators will require expert judgment. Risk Robot includes expert judgment and would like to invite you to test Risk Robot with your own data. Our team consists of ex-bankers and senior credit risk experts who are leading large teams in global Tier 1 banks. We have developed a global network of partners who are also supporting us at the implementation of our product in different markets. We are currently expanding in the US market, and we are very pleased with our participation during the Accenture FinTech Innovation Lab in New York. We had an amazing online experience during the last weeks with mentors and sponsors from the participating financial institutions. We learned significant strategies for product positioning and market penetration, and this allowed us to focus on the real needs of our clients and adjust our presentation for the US-based banks. We feel grateful as we received awesome support from all the team members of the Partnership Fund of New York and Accenture, and we are currently organizing our permanent base in New York. Join us and accelerate your productivity at speed and at scale. Thank you very much.
Hi, my name is Robert Fasadello from Wells Fargo, and I'm here to introduce you to Delio. My team and I have had the pleasure of working with Delio during this year's FinTech Innovation Lab. We've been impressed with Delio's globally focused team, who are all hyper-cognizant of the shifts in demands amongst today's wealth creators. Today's modern wealth creators are increasingly interested in the alternative illiquid investment space. Delio is addressing this need with their unique suite of solutions. With their white label technology, they support financial institutions in distribution, compliance, and operational efficiency within private markets, all while promoting a high level of data transparency and analytical expertise. Like me, I think you'll also enjoy getting to know the Delio team and their suite of products better.
Hi, I'm Gareth Lewis, co-founder of Delio. Delio helps financial institutions of all sizes to transform private markets for their investor clients. My co-founder and I's backgrounds were in corporate finance and wealth, and what we experienced was a monumental shift in the demands for today's wealth creators. Today's wealth creators are looking for access to investment opportunities that they can understand and relate to, and these opportunities exist within the illiquid space, be it accessing alternative funds, private placements, real estate deals, or anything in between. Yet despite this interest in companies staying private for longer, financial firms are struggling to tap into, let alone scale in this space. Financial firms have three options. Firstly, they could avoid offering private markets altogether. Secondly, they could offer a private market proposition that relies on manual process, but this means that they're slower to adapt, and there's a risk that client demand can outgrow resource. Neither of these two options truly meet investors' needs, meaning these firms are at risk of losing clients. So the third option is to build an engaging client proposition in the alternative space, and this is where Delio comes in. Through Delio, investors can now see what the banks can offer them in a single place, whilst the internal users can streamline the entire investment process around private markets. From promoting deals to tracking performance, our technology allows users to access, complete, and interact with investment opportunities, whilst giving advisors the data they need to truly understand their clients' investment needs. At Delio, we are on the journey to creating a globally connected private market infrastructure that broadens access, transparency, and liquidity in the space. So if you or your firm wants to give its clients access to a diverse range of investment opportunities, then please get in touch.
Welcome, everybody. Really excited to have you join our demo day, and in particular, our Fireside or Bookcase chat with two great friends of the FinTech Lab, Matt Harris of Bain Capital Ventures and Carrie Davis of Warburg Pincus. Let's start with general trends. According to our friends at CB Insights, the first quarter of 2021 had the most venture dollars going into FinTech since they started tracking it, which was, I think, the first year that they were in the FinTech Lab. So let's start with what's behind that. What's driving the fact that there's so much money piling into FinTech, even as we're coming out of a pandemic? Carrie, why don't I start with you?
Sure. I'm sure all of you have seen Satya's quote that we've accomplished 2 years of acceleration of digitization in the banking world in 2 months with the pandemic. And I think that you lay that against the fact that most of the banking industry's tech stack was built in the 60s, and you have an industry ripe for transformation. And banks have sort of put that off for a long time. And with zero interest rate environment, they're not really making a lot of money and don't have the wherewithal to spend on completely renewing their tech stack the way they used to. And so I think that that's the big driver. And that leads to a few things that we're focused on. But Matt, you might want to comment on the overall environment first, and then we could talk about the themes that we're looking at as a result.
I think it's not so much in spite of COVID as it is because of COVID. It really, for all of us for a quarter or two checked up, but then it was Katie bar the door and investment ramped up, both corporate investment, like Carrie describes, and relatedly growth equity and venture investment, and not just banks. I think insurance companies, perennially the laggards in IT investment have got the memo that they too need to keep up with the insurtechs and rising consumer expectations. Broker dealers, asset managers, it really is across the board.
And are there any of the subsectors that have seen more investment than others that you want to sort of call out?
Sure. Payments is the perennial leader in this regard. I personally, though, have observed that it's really late stage payments companies raising scale capital. We're actually seeing fewer raw startups in payments, and I do think increasingly we're running into some fair share of solved problems in payments. Not all of them, but there's less wide open space, I think, for payment startups. When I contrast it, for instance, to insurance, where there are some sort of bold-faced names and insurtech, public companies like Lemonade and Root, and insurance technology companies like Duck Creek. But the fact is, most segments of insurance remain very untransformed, and there are still big problems to be solved. So we're seeing more heat. And certainly we're spending more time on early stage insurtech than we are early stage payments.
And Carrie, what are you seeing?
We've been focused a bit more on a horizontal theme of embedded fintech. And it really started in the payments world, where you have point of sale merchants getting solutions where the payment flow is embedded into the software solution, and they were given the software for free in exchange for getting to keep the interchange. And that really disrupted the fact that the vendors who sell software solutions and weren't capturing payments were at a disadvantage because they were trying to charge for their software, and the banks that were collecting the interchange don't really have the ability to provide the software. And so it was hard for either set of competitors to compete with that. And we're starting to see that in insurance and a variety of other sectors where, especially where there's more knowledge about the customer, you're able to be more disruptive to the incumbent players. There are a lot of regulations around what consumer data you can use to make decisions, such as lending decisions or insurance decisions, but you can't use the data to discriminate But what you can do is offer people who you screen and appear to be attractive to you preferential rates. And so if you know that a certain customer, or have a strong belief that a certain customer is likely to be a better credit risk than their FICO score would entail, because you also have access to their transaction history for the last 5 years and they don't bounce checks and they routinely deposit a paycheck, then you might be willing to offer them cheaper credit than they could get in the open market. And similarly in insurance, if you had some way of knowing somebody was a good driver or was healthier, you might be able to offer them something that was a benefit to them without discriminating against people who were applying.
And we'll come back to the whole question of data, because there's a lot to delve into on that one. But keeping with the current environment, how sustainable is this, these high levels? Is this something that you think this is going to be a peak? And I know I'm asking you to each get out a little bit of a crystal ball on this one, but is this a peak? Do you think the high level of interest is going to continue from the investment community?
Well, I think there's two phenomena that are interrelated. One is the volume of funding, and the second is the valuations at which that funding is taking place. I think in terms of volume, when measured against, global market cap of financial services, it doesn't jump off the page. I mean, I think if you believe, as I do, that all of financial services globally is being disrupted by technology, and you put the numbers in that context, you look at, say, the funding for Nubank in Brazil, and you think, well, it's actually now the largest financial institution in Brazil. It's not crazy that Warren Buffett would invest hundreds of millions of dollars in the largest financial institution in Brazil. So I think contextualizing it relative to the market cap of global financial services, so 20% of global market cap overall, I think these numbers can be sustainable if you believe that technology is going to kind of keep marching. And I certainly view that as an article of faith. I think the more worrisome part for us, probably for Carrie as well, is the valuations, which don't seem sustainable. I think we've seen an evolution of private capital to where there are a set of players who are, aggressive in an unprecedented way on valuation and in terms of how quickly they move. And that is clearly behind the growth in funding, but more so and more worrisome, it's leading to a sort of brittleness around the cap tables of some of these companies and the private market valuations. And that, I think, if there's going to be something where we look back at 2021 and shake our head and regret sort of an over exuberance, it'll be less about the volume of funding and more about the values.
Interesting. So Carrie, if you could also speak to the U.S. versus international, and are there, as you look at the world, because I know Warburg in particular invests globally, are you seeing more fintech opportunities globally outside the U.S.? Is it equal? Talk to us about that differential, if there is one.
Well, there are substantial opportunities globally. We're seeing plenty in the U.S. as well. The European financial institutions tend to be a bit more country-based, and therefore they tend to be more modest in size than the U.S. institutions. And also their regulators tend to have more open views about how data should be used and who owns it, which also facilitates innovation in the next generation of players. So bank charters are easier to get in the UK and on the continent, and there's open banking laws that require that the banks share your data if you ask them to with whichever vendor you want that data shared with. So that fosters a bunch of innovation that's a little harder to come by here in the States. And in Asia, there's tremendous opportunity, but again, the markets there are quite different because they just jumped past an entire, probably couple generations of financial services and tech infrastructure and ended up at a very different endpoint because they don't have a whole bunch of legacy stuff to deal with, and their products are different, and they've actually got a smaller number of huge behemoths that you've got to figure out how to dance your way around.
Interesting. Let's leave the broad trends and delve down now to a couple of very topical areas. And I feel like we have to start with digital assets, given all that's happened. So you've got the fact that the FBI was able to pull back some of the ransom, the Bitcoins from the Colonial Pipeline ransomware attack. You've got the Basel committee's just come out with some recommendations around what the capital requirements are for banks to want to hold Bitcoin. And they put crypto assets at the very high end of where capital requirements are. And El Salvador's adopted Bitcoin as legal tender. So Matt, let me go to you for this one. So what's the impact of these three things, particularly the first two, on the Bitcoin market, the future of it as a asset class, if you will, held by regular investors versus more speculative holders? So what are your thoughts on this?
I think they're consistent with a broader pattern we're seeing, which is increasing maturity in Bitcoin specifically, and Bitcoin alone, by the way. The rest of crypto, in which we're also very involved, by the way, is at a far earlier stage of maturity, is, could be fairly described as the Wild West. By the way, a lot of fun and interesting things happen in the Wild West. That's not a criticism, but it is just a fair description of the level of volatility. But Bitcoin itself surely has price volatility, but as an industry, as an asset class sort of unto itself, as digital gold, just by way of shorthand, I think it has reached a new plateau of acceptance. I think the fact that it's no longer quite so useful for criminals is a good thing. That is definitely a feature. I think the fact that it is given a very high, the highest risk rating by the Basel Committee is amazing. That the Basel Committee is thinking about it, and feeling like they have to grapple with it. So I think these things all represent positive trends in the sort of Bitcoin is here to stay. Now, whether it's 40,000 a Bitcoin or 4,000 or goes up to 80,000, all those things are quite within the realm of the possible. But I think, there's more and more indications that Bitcoin will be, in the pantheon of assets for folks and institutions to consider investing in. And the last thing I'll say about it is one area where New York City is just unquestionably the dominant player between DCG and BlockFi and NYDIG and Galaxy Digital. And I mean, it really is the epicenter of particularly the Bitcoin economy in a way that I think stands to reason, considering Bitcoin as an asset class. Like, where else would be the home of a new financial asset class?
As a long-term store of value, there are many things that you want, or especially if it's going to be digital gold. And you want price stability. You want ideally something that's counter-cyclical. And Bitcoin has been highly and relatively stable. Bitcoin's been highly volatile and highly correlated with the equity market, as opposed to opposite to the equity market or stable. So as a long-term store of value, I still struggle with seeing that as something that might underlie transactions. I have an easier time seeing how that is helpful. Somebody said currencies need armies, and I still am a bit of a believer in that. And the Basel Committee, I think that the central banks are going to do everything they can to fight this, right? The US government, as the reserve currency, will do everything it can to fend off against any other possible reserve currency.
The majority of the financial institutions in this year's FinTech Lab actually asked for solutions around ESG. And it was the majority, I would say a good 60-70% of them were looking for new solutions. And that was definitely something new for this year. So I want to spend a few minutes talking about that. And two of the companies in this year's class are focused on this ESG space. So what do you think is driving this interest in ESG?
There's a generational shift that's behind a lot of it. Like, for instance, at Bain Capital, we've invested a huge amount in our internal ESG, really all three of those dimensions: environmental, of course, but also elements of social justice, particularly here in the last 15 months, and then governance, which has been a core part of really any private equity firm, but certainly we see it as one of our core differentiators. So we have leaned in part because our customers, limited partners, do expect it of us and demand it. And that's driving ESG everywhere, which is the customers. But in our case, even more so, it's the employee base. People want to work at firms that reflect their values. And increasingly, as our workforce is made up of 20 and 30 and even 40-year-olds, they belong to generations where they expect work to reflect their values. So I think there are lots of pressures on this by these younger generations who grew up espousing these values and expecting them from the institutions at which they work and from whom they buy asset management products and all sorts of products. And I think you could comfortably say in generations past, as Churchill did, that people tend to be liberal when they're younger and grow more conservative as they age. We haven't seen that in some of these latest generations, and perhaps that reflects a growing, deep and abiding concern about the environment in particular, which is not getting better and is not sort of something we can just put aside and move on and start focusing on more material things. So I think there are meaningful societal and environmental challenges that are increasing, not decreasing, do not seem to be cyclical, seem to be secular and growing more troubling. And we have generations now who can't set those issues aside. So I have concerns, to be clear, about ESG in investing. I think it is a very complicated matter. We have an impact fund at Bain Capital. I serve on the investment committee and have for 7 years. And we've worked incredibly hard to balance what do we mean by impact and how do we balance that with return? And in particular, in our case, how are we entirely non-concessionary about how we drive return while driving impact?
Yeah, because data is a big part of this. Is what are you measuring and how do you measure it? So Carrie, what are you seeing in this space?
I agree with all of Matt's comments this time, and I think that it goes one step earlier in terms of the pressure for ESG. It's not just our investors, but our investors are hearing it from investment committees and individuals who are asking for what is the ESG profile of the managers that they're investing with or the funds they're investing in, and we're hearing it from investment committees as well, and so that it's an increasingly important thing driven across. I think that creates, what we're most looking to do is great utility business models. So there's data collection, data sharing, analytics and evaluation, think almost ISS for ESG, and across many stripes of different types of investing, and how do you evaluate having some third-party marker of how well you're doing on the ESG front will be really useful to investors, because it'll be impossible for each investor to evaluate every different opportunity and come to a point of view on that.
Included within ESG is sometimes financial inclusion. And it's obviously something that we at the Partnership Fund, think a lot about. So wanted just to spend a couple minutes on that. And there's a little bit of a quandary, right? So as the financial sector moves towards more digital payments and the use of digital tools for payments, you've got a segment of the economy and the population, the un- and underbanked, which are heavily cash-based. And so how do you balance and moving towards a more digital society, but yet not leaving that population aside? And there's some political implications for this, because you now are starting to see municipalities passing laws prohibiting digital payments because they've got a bunch of constituents that are not able to participate and are cut out of buying things at a particular retailer. But Matt, I know you've thought a lot about this issue. So what are there some good tools that we should support or be aware of to solve this problem?
Yeah, I think, the cash preferred unbanked, underbanked segment is among the needier segments in our population. And so we need to be incredibly thoughtful about not discriminating against that population. That said, cash is like the original Bitcoin, right? It's not a good thing from a policy perspective. It is untraceable, and it is actually the primary tool used in crime. And so I think we as a society need to move to more fully digital methods of payment from a safety and soundness and taxation perspective, and really all of those things, which I think we can all agree are important values. So how do we do that fairly? I mean, a lot of the benign reason for cash preference is the products available to this population has historically been atrocious. They've been extremely expensive in the it's very expensive to be poor kind of way. But we can understand that. It wasn't like anyone was making huge money off this. You know, the cards available from the major banks to this population had high fees and overdraft risk, et cetera, because they couldn't make any money otherwise. So to me, the solution is companies like Varo and companies like Mochify, who are building products that are just fundamentally different from a cost structure perspective. And so can offer very high quality, in fact, much higher quality than most of the kind of retail banking products offered by major banks, with none of the fees and none of the sneaky risks like overdraft.
Let's move over to the data privacy space. One of the burning questions, which is who should control an individual's financial data? And what restrictions should there be on how it's transferred, what's done with it, who has access to it, et cetera? So what are your thoughts on that sort of major question of our time?
So I firmly believe that the data should be the property of the consumer and not the financial institution, and the consumer should decide where and how the data gets used. And that is not the current stance or posture of the US regulators, but many of the European regulators have come to that point of view. And it's great at entrenching the current players because it makes it hard for competing products to come into the market and pick off customers unless they wholesale move their accounts. But it stifles innovation and next generation players.
In the data space, Querio, what are some interesting investments that you've been working on or seeing?
We've been investing broadly in data infrastructure, but in particular around this consumers being able to use their data or how do they benefit from their data. Companies are doing that, right? Varo, for instance, which Matt mentioned earlier, as the neobank with the charter, they were able to use a consumer's financial history in making, in deciding who to offer certain new products to. Again, with premium offers as opposed to something that would be discriminatory because people were applying and you were deciding not to give them something.
So I'm going to switch a little bit to another topic area here. What are the subsectors in financial services that you think are the most ripe for disruption over, let's say, the next 2-3 years?
Lately, I've been spending a lot of time on asset management because there's clearly been a lot of activity in wealth management, starting back with Betterment and Wealthfront, both of whom are, a decade old and obviously at scale. The sort of robo-advisor movement, SigFig, et cetera. Again, lots of great founders toiling away for a long period of time to change how we receive advice on how to allocate our money, et cetera. But in terms of manufacturing products, the business of BlackRock and Fidelity and T. Rowe and, Warburg Pincus, those industries, those companies have been like, name one startup who competes in asset management. The historical belief is that it takes, decades of trust to build a brand, for, companies to buy your products, et cetera. I'm increasingly skeptical of that. I think there are really interesting models built on, the fundaments now of fractional shares and lower costs of trading, lower costs of compute. You can run individualized portfolios for investors as an asset management firm. It looks a lot like wealth management, but it has the economics of product manufacturing, those incredible incremental margins at scale.
And Querio, are you investing in the disruption of venture capital? Just sort of or are there other areas that you're looking at for disruption?
I'd have one, I completely agree with Matt's comments, but would broaden them a little bit to say, each generation of technology tends to bring about both a bunch of vendors that are leveraging that technology to sell to established players, be it in financial services or other markets. In energy, I think we're seeing a lot of activity against the banks, where the cost structure of a neobank is just so much lower than the legacy banks that, as Matt well articulated. You don't need to charge the same fees to make a customer profitable. And that then opens up 150 or 200 million customers who can be served by the majors, but they're not profitable to the majors, which is why they charge all those fees. They're not doing it because they're trying to be usurious. They're doing it because otherwise it's uneconomic for them to offer those accounts with their cost structure and their inability to have real-time systems to manage losses. So broadly speaking, I think we'll see this we're seeing it in insurance now. Matt mentioned Lemonade and other vendors that are that are cropping up to do that. And then one other area where I think has historically gotten less attention, but is sort of Matt and my business, not with direct competitors in our business, but the whole private markets. And, we still work by phone and spreadsheet, and, everything around us has been automated and digitized and become more efficient. And if you looked at our business processes, they are not. So
Still paying Microsoft for Excel. Yep.
But Carrie, you and I are such precious snowflakes that we can't be automated or replaced. I mean, unlike every other industry in the world, you and I mean,
you guys are both special. It's true.
Thank you. I needed that validation.
I hope you meant that in a positive way.
I did, yes, only positive. Now we have to talk about SPACs. Why have they been all the rage? Why so widespread? And are we at the end of that trend?
Well, I sit here as a beneficiary, just I know as Warburg is and as the partnership fund is, we'll take ultimately 3 companies public via SPAC this year, just in FinTech alone. I think boards have matured their conversation about what a SPAC is and what it isn't. It's frankly just an alternative method of getting public that is more expensive. It's not as expensive as it was in the days of unnegotiated sponsor promotes, but it's a more expensive way to get public. It helps companies who really need to tell a future-oriented story versus just here's last quarter and our history. And there are a number of companies, young companies, who need that in order to get the valuation that they feel they deserve. And it offers, enhanced timing and certainty, at least in my experience. So I think it has a role in capital markets. I think just like everything, the exuberance just got like massively carried away. And there's way too many sponsors out there. And I think some really good percentage of them are just not going to ever find a target. The threshold is quite high, higher than it was even a couple months ago to get a deal approved and get a deal funded. And again, fewer and fewer of these many sponsors against a narrowing target pool are going to find acceptable transactions to do. So I think this is the air whistling out. This is my favorite way for bubbles to end is air whistling out. There are way worse ways for bubbles to end. And sadly, I've lived through a couple of them. So if this is, how SPACs kind of, die with a whimper versus with a bang, and they don't even die, they just get relegated to, a relatively narrow proportion of companies coming public.
Gary, your thoughts on SPACs?
There's some category of companies that are relatively lower growth that would be perfectly fine public companies, but won't generate the kind of excitement by traditional IPO buyers. And so they really just didn't historically have a path to go public. And so for those companies, SPACs are really valuable, even though they are expensive to do relative to a traditional IPO, although I think that they'll end up coming a little more in line. The second point that Matt made about the fact that projection-oriented companies do that, there's a bit of regulatory arbitrage at the moment where traditional IPOs are not allowed to share projections, but SPACs are. And I find it hard to believe that regulatory arbitrage will persist, and that regulators will either say that regular way IPOs can share projections, which they probably won't because they really slap your wrist when you do anything that might look like a projection. And I think more likely they lock down SPACs' ability to share projections and level the playing field there. Level the playing field there, which I think will take out quite a bit of the exuberance for some of these vehicles.
Yeah, the FinTech Lab, which we set up back in coming out of the financial crisis of 2008. The goal was to help make New York City a center for FinTech. And New York's obviously taken a bit of a blow during the COVID-19. So just give us your thoughts on the future of FinTech in New York, FinTech and InsurTech in New York.
I'm really bullish. I think overall, the fall is going to be like the Roaring 20s. And I think it's no accident that the Roaring 20s came after the 1918 flu pandemic. So, right, people have been cooped up, unable to do things. I think that, there's going to be a snapback come Labor Day, assuming no variants go rogue. And so I think it won't be exactly the way it was, but I think there'll be a lot of energy and a lot of people back in the city. And, part of the reason you set up the FinTech Lab originally, Maria, was that New York has, if you do Michael Porter's 5 forces, right, it has comparative advantage in financial services broadly defined. And if you're looking to sell to financial services firms, they're all here. And I think that New York will remain one of the most attractive places for FinTech companies to locate themselves, or at least have a significant presence, because it puts you right in the pocket of so many of your customers.
Glad to hear that. Matt, how about over to you?
Happy to agree. And I would also add that, the advent of, digital methodologies for work basically means that people get to choose where they want to live more and more, not sort of to the limit, but more and more. And to my mind, that helps New York City. Like, New York City's talent value proposition for people in their 20s and 30s is unbelievable. Like, is it for everybody? Can everybody make it here? Probably not. But for those who are hyper competitive, who want to win in the most competitive market in the world, who want to have the best of everything and be in the game, be in the arena, there's no better place than New York City. And so I think in a fair fight in terms of talent, I think New York City's value proposition for that talent is unique, differentiated, and we're going to be a winner.
We may put you both in a PSA, so stay tuned for that. All right, we got a couple last questions, but rapid fire. So 1 word or 1 sentence answers, just to round off our fireside or bookshelf chat. So name 1 FinTech trend that's overhyped and 1 that is below the radar that people should pay attention to.
I still think blockchain is overhyped, just as a nonsense concept that corporations like to mutter. Underhyped decentralized finance, the flip side of that coin, protocols and tokens.
Okay, Carrie?
I'll move to SPACs.
Okay. And how about under the radar?
Overhyped, and under the radar would be the area that I mentioned before, where we're spending a bunch of time, which is how private markets are on the path to being automated.
Okay. Great. What is 1 thing that each of you started during COVID that you think you're going to continue? Carrie, over to you on that one.
I don't think I will be in the office 5 days a week anymore. I think I will be there 4 days a week.
And Matt?
Dinner with my kids, and lunch some days too, although I expect that'll go away. But it's just a function of traveling less and recognizing that I can do first meetings over video versus, flying to Kansas City for a 45-minute session.
So 1 piece of advice as those FinTech and InsurTech entrepreneurs look forward to what will hopefully be a roaring time in the city, lots of money coming in, but 1 piece of advice for them sort of with that framing. Carrie, over to you.
I would say seek out your critics. Try and find people who are telling you that what you're doing isn't right or isn't going to work or has a problem, and not because you have to believe them and not to depress you, but the more that you can iterate and listen to people who have criticism of what you're doing, the more you're likely to tweak to a path where you're going to be successful.
Great piece of advice. And Matt, piece of advice for the entrepreneurs.
Think about diversity starting with your first hire. I think many companies think about it when they get to 100 employees and say, oh boy, we got a problem. How do we solve for diversity? And I don't mean just racial and gender diversity. I mean diversity of thought, diversity of educational background, socioeconomic diversity. You'll have a much better company if you start incorporating that into your hiring from the very beginning versus trying to retrofit it on a scale company.
Great advice from both of you. And I think we could do another session just on advice from Carrie and Matt. But we're going to call it a wrap right here. Thank you guys both for joining us this morning. Appreciate your comments, your commentary, your support of the FinTech Lab, and all the great work that you're doing investing in companies in New York to help make New York a great tech center. Now we will go back to finish up the balance of the presentations for Demo Day, and hopefully we'll see you all in the breakout rooms this afternoon. Thank you very much.
Maria, congratulations to you for having launched the lab. It's had a big impact on New York and FinTech in New York, and it's really gratifying to see how it's grown and flourished over the years.
Thank you. I hope you enjoyed that really interesting discussion with Matt Harris and Carrie Davis, 2 great venture capitalists who've been wonderful supporters of the FinTech Lab from the beginning. and had some really interesting things to share about the sector and also the future trends. But now let's go back to our program. And I'm going to turn things over to Manoj Govindan from Prudential Insurance, who is a new sponsor of the FinTech Lab this year. And Manoj and his colleagues have been mentoring CoverGo, and Manoj will do the introduction of CoverGo. So over to you, Manoj.
Hi, Manoj Govindan with Prudential Financial. The business of insurance is over a century old. Personalization has all along been a mantra for this industry. What has changed is the speed and agility at scale that our products need to compete in the increasingly digital marketplace. So at Prudential, we are focused on making the business of insurance, sales, underwriting, distribution, claims, or service, tech forward. CoverGo, with its no-code modular architecture, over 500 insurance-specific APIs, and a multi-cloud deployment, has intrigued and impressed us with a couple of use cases, both to discover emerging markets with rapid build and deploy of insurance and to modernize legacy insurance back office operations. We've been delighted to engage with the CoverGo team, and here to tell you more is founder CEO of CoverGo, Tomas Holub.
Hi, I'm Tomas, and I'm the CEO and founder of CoverGo. CoverGo is an insurance technology company based in Asia and expanding to the US. We work with P&C, life, and health insurance companies, helping them to digitize their product distribution and policy admin processes in days and without a single line of code. How do we do it? We have built the first fully configurable modular insurance-specific no-code platform, powered by over 500 open insurance APIs. We are different from generic no-code platforms by focusing on insurance only. We have built all the insurance building blocks and modules ready out of the box. At the same time, we provide companies with the no-code flexibility, allowing them to build their own products and their own workflows in a drag-and-drop manner. I believe this unique combination of no-code applied to the insurance industry is the future, and CoverGo will be driving it. So how do insurance companies use CoverGo? First, building and launching products in days. It used to take years to build products in a traditional way. Now with CoverGo, it only takes days. And we support all types of insurance, from simple P&C products to complex commercial lines, health, group health, and life insurance as well. Second, we help companies develop omnichannel distribution. And third, our policy administration system helps companies to increase operational efficiency by automating and digitizing all the policy administration processes and claims. Overall, we have already digitized more than 30 product lines, and we have 30 enterprise clients in APAC and the US. To conclude, I would like to thank the FinTech Innovation Lab, all the organizers, mentors, and sponsors. We have received lots of valuable feedback, and especially by working with the institutions, including CHAP, Prudential, AIG, Global Atlantic, and New York Life. We have learned a lot, and we also identified a few use cases that we are now exploring. Thanks a lot.
My name is Jeff Gallimore, Chief Operating Officer, U.S. National Accounts for Zort North America. This is my 4th year participating in the lab, and I could not be more excited to introduce Vestu on Demo Day. When we look at the insurance landscape, every carrier has something in common. They carry risk on their balance sheet. Over the years, there haven't been many alternatives to reduce it, which is why Vestu is so unique. Vestu was founded in 2008 as a risk management alternative for life and P&C markets. They specialize in developing risk models which provide alternatives to traditional insurance and/or balance sheet relief of the insurer. So this is how it works. The insurer provides Vestu with raw data on a portfolio. Vestu then cleans that data, models it, and provides a financial structure. Vestu then takes that deal and places it with investors through a network, capital markets, or banks. Seniors are provided with real-time updates on actual versus expected losses and updates on capital requirements. Vest2 has modeled over $6 billion. Now, all carriers have expected losses, and Vest2 not only validates the losses, but offers a different way to transfer risk. In the end, Vest2 gets invaluable mentoring through this program as they refine and test their product with senior executives. For Zurich, it's an opportunity to continue advancing its commitment and innovation to best serve its customers. Best wishes to Vest2.
Hi there, my name is Yaniv Bertele. I'm the co-founder and CEO of Vest2. Vest2 is an alternative risk transfer and hedging platform, enabling for the first time ever broad and effective risk transfer from the insurance space to the capital markets, creating a complementary alternative to traditional reinsurance. The insurance market has suffered significant challenges in recent years, which threaten its continued sustainability. Therefore, the industry must find innovative and flexible ways to limit the risk exposure and optimize capital management in order to control costs and stimulate growth. Unfortunately, reinsurance providers, faced with many of the same issues facing their clients, are unable to meet the growing market needs and capital requirements due to a limited appetite and capacity to assume risk, leaving a huge funding gap in the insurance markets. And that is exactly where Vest2 comes in. Our platform utilizes advanced proprietary artificial intelligence and machine learning technologies to provide insurers, that is the risk carriers, and the pension schemes with data-driven risk transfer solutions using the capital markets to hedge liabilities and transfer risk. We're disrupting the traditional reinsurance market by radically changing the way that risk is assessed, modeled, managed, and transferred. Our proprietary machine learning-based technologies build accurate and objective stochastic risk models which assess distributions and probabilities used to quantify future payments for selective insurance portfolios. These risk models give Vest2 the ability to accurately and rapidly transfer risk to the capital markets. Vest2's models replace cumbersome manually entry and calculations performed by actuaries in traditional reinsurance, which has not substantially changed in decades. As opposed to traditional reinsurers, Vest2 doesn't carry the risk itself, but instead enable risk transfer to the capital market investors, such as banks or funds, which in return receive investments with attractive yields that are uncorrelated to the capital market volatility cycle, along other significant benefits, such as diversification points for their portfolios. The capital market can potentially provide unlimited amounts of capital, more than enough to bridge the funding gap in the insurance markets. Furthermore, Vest2's platform and objective, accurate risk models allow insurers and pension funds to transfer risk and hedge their liabilities at a lower cost and faster time to market, also catering to small to mid-size insurers, which would otherwise be lacking proper risk management solutions due to high reinsurance prices. Vest2 is well positioned to revolutionize the reinsurance market, providing the industry with sorely needed risk transfer and comprehensive protection, allowing insurers to maintain their competitive edge, spur growth, and sustain profitability, as well as meet the challenges of the global pandemic and dynamic market conditions. Our vision is to create a world where insurance and alternative capital are fused and globally accessible.
Hi, this is Preeti Asthana from Aon. Insurers are often constrained by resources to effectively identify third-party liability and act upon the full extent of subrogation opportunities. This is where Safekeep comes in. They try to solve this problem for insurers by leveraging both leading-edge technology as well as deep expertise in insurance to overhaul the subrogation process and turn it into a profit center for carriers. Safekeep uses machine learning, NLP, entity resolution, and rules-based automation to digitize subrogation and maximize dollar recovery for insurers. We and the other mentor financial institutions have developed a number of interesting use cases with them to realize the full potential of subrogation opportunities. We have been extremely impressed with the Safekeep team and their expertise in getting to the core of subro. To tell you more, here is the CEO and founder of Safekeep, Jeff Doe.
Hi, I'm Jeff, CEO and founder of Safekeep.com, a subrogation platform which mines raw claims data for profitability and which has increased profits by as much as 20% for our key customers. We are complementary and additive to your existing claims department in 3 key ways. First, we apply predictive models to all phases in the claims journey. Second, we partner with leading law firms to curate and automate over 4,000 regulatory rules. And third, we apply semantic search and natural language processing on claim notes and unstructured documents to extract key entities, such as liable third parties. We serve insurers in auto, work comp, property, general liability, and employee benefits. And we're solving a big problem. Up to 20% of total paid losses could be recovered, yet insurers recover only a fraction of that due to the manual nature of back office processes. Today, people actually have to manually review each claim. Safekeep solves for that. We're proud of our traction across all product lines, having processed over 2 million claims and over 15 million claim notes. Out of 1,400 other insurtechs, we won the Global Gold Award from Zurich in their Innovation Championship. We won the Global Silver Award from FMA and Accenture. And in addition to being part of the FinTech Innovation Lab, we are working with syndicates through Lloyd's Labs in London. Not only are we embraced by Tier 1 carriers, we are working with some of the world's largest insurtechs, such as Root. Prior to founding Safekeep, I was the former global head of insurance at Salesforce. And our chief data scientist is Tom, a trained medical doctor who did his postdoc research at Harvard Medical School and spent his career applying machine learning in healthcare. Kevin, our chief claims officer, came from Allianz and was the former president of the National Association of Subrogation Professionals. And our head of products, Andrew, spent over 15 years at Liberty with a track record of building subrogation units. We have a bigger vision that will transform the industry, and we are planning to raise our next round of funding to accelerate our growth. If you have any questions, please don't hesitate to reach out at jeff@safekeep.com. Thanks.
Hi, my name is Lexi Tran, and I'm from Morgan Stanley's Technology Business Development Team. Supporting the NIFIL program as a chaperone for the last 3 years, I've noticed a few attributes that make startups particularly successful throughout the program. These attributes include the ability to take and implement feedback, address a pressing business problem from a new lens, and an eagerness to learn about bulge bracket banks. Patrick Wood, the CEO of Util, and his team embody these attributes to a T and have been an absolute pleasure to collaborate and ideate with during the NIFIL 2021 cycle. In an industry with tremendous appetite for ESG solutions and limited gold standard products to address customer demand, Util's solution is beautifully clear. Util leverages machine learning technology to measure how companies, positively or negatively, contribute to each of the 17 UN Sustainable Development Goals. I'm delighted to introduce Patrick to share more about Util today.
Hi, I'm Patrick, CEO at Util, and I'm going to take 2 minutes to tell you about what we do. Using machine learning and other technologies, we've created the world's most comprehensive, detailed, and objective dataset measuring the impact of companies on the world. Our clients can use our data in many ways to report on the impact of their portfolios, or to develop new financial products like funds or indexes, or to engage with companies using evidence-based insights from our data. Why is this important, you may ask? Well, there's been an explosion in demand for so-called ESG investments that promote good environmental, social, or governance outcomes. Over $30 trillion is projected to flow to investments labeled as ESG in the next 4 years, making ESG 2/3 of the world's total AUM by 2025. And yet, what counts as good or bad in ESG is still a matter of opinion. Usable data doesn't cover that many companies and does so only in very basic categories. Without objective information, greater coverage, and greater detail, investors face huge risks, potential losses, and firms will struggle to differentiate themselves and attract or even retain assets, which is where Util comes in. We address these issues in 3 ways. First, objectivity. Starting with over 120 million source texts, we have the only fully automated process for gathering and measuring evidence, which gets us as close as anyone can get to complete objectivity. Second, coverage. Because we have automated this process, we can do it for more companies than humans could on their own. We cover every listed company in the world. Third, detail. We capture fine-grained, real-world trade-offs rather than blunt categories. We offer hundreds of evidence-driven data points for 45,000 companies. And what's even better is that while we covered lists of companies for the moment, our technology will also work in a similar way for private companies and other asset classes, offering comparable objectivity and detail across an even wider range of investments in the future. I'd like to thank the FinTech Lab for having us this year and also thank our sponsors who have been wonderful to work with. And if you're interested in better data on the impact of companies on the world, please get in touch.
What if you're an asset manager thinking about buying Miami real estate? Of course, you go through the standard financials to determine value. Wouldn't it be smart to include climate risk as part of your bet? How about putting a price on climate change? If you had such a tool, you can make wise decisions to avoid catastrophic loss, have the right insurance, and save dollars through improved negotiating. The Climate Service has your answer. They help clients, like the federal government, like asset managers, integrate climate risk into intelligent decision-making. So it is my pleasure to introduce the CEO, James McMahon. He's going to tell you more.
Hi, I'm James McMahon, CEO and co-founder of the Climate Service. I was trained as a scientist at Harvard and MIT and as a business person at Coca-Cola. The Climate Service is a risk analytics platform that enables you to measure and manage your financial risks due to climate change. Whereas typical ESG looks at your impact on climate change, we help you measure climate change's impact on you. We tell you the impacts on your company in financial terms so that you can treat climate risks just like any other business risks, like cyber or political, and report to regulators and investors. Portfolio managers can now improve their risk-adjusted returns. Risk managers can now prioritize their mitigation efforts. This used to require a long, expensive analysis, but our platform does it at the click of a button for any asset, anywhere in the world, anytime between now and the end of the century, from the rooftop level to the company level to the portfolio level. What makes us so unique is our library of over 1,000 proprietary econometric functions, which enable us to model nearly any type of asset. That's why Forrester Research named us a leader in climate risk analytics. We offer an annual subscription to our service, and over half of our revenue is now in multi-year contracts. Our customers include pension funds, asset managers, and real estate investors. Our channel partners include Aon, IBM, and other large consulting firms. Our investors include AICPA and the Wells Fargo Startup Accelerator. Our team is currently 24 people, and our advisors include 4 IPCC Nobel Prize-winning scientists. We're growing at about 300% annually and raising a Series B now to invest in capturing what has been estimated to be a $15 billion market. We'd be excited to partner with you, and we're super grateful to the FinTech Innovation Lab for their support.
I am Murtaza Himani from Accenture, and I'm joined by Yasmin Lilani from the Partnership Fund for New York City. As co-heads of the FinTech Innovation Lab, we would like to congratulate the 10 startups from the 2021 cohort that we just heard from on completing this rigorous accelerator program. We look forward to your continued engagement and growth in the financial services sector in New York. It has been an absolute honor to help drive and facilitate the collaboration between financial institutions and the startups. We greatly appreciate the support of all our partners who so generously give their time and expertise in order to make this lab a success. We would also like to thank our audience for taking the time out of their busy schedules to get to know this year's cohort of startups. Before we wrap up this portion of our demo day, we would like to highlight the various ways you can continue to engage with us and the startup teams.
Thanks, Murtaza. We've all just watched a brief snippet of some of the many offerings of high-quality startups. We encourage you to get to know them better by using the Explore section below on this page. With the Explore section, you can watch more in-depth pitch videos, download pitch decks, and most importantly, schedule one-on-one meetings with each startup team at your convenience. We also invite you to join us from 12:30 to 3 p.m. today in individual breakout rooms with each of our startups. If you scroll down below, you can find links to join each startup's respective breakout room. Each room is scheduled for 30 minutes, and we predict there will be quite a bit of enriching dialogue about startup value proposition, product demos, use cases, and more. Thank you again for joining. As you know, the FinTech Innovation Lab is run annually as a civic program to promote economic development, entrepreneurship, and advancements within financial services and insurance for New York. Your continued support is both valued and appreciated. We look forward to seeing you at our next lab event. Thank you.